Well, while we're on the topic of jobs, we're going to be talking about the jobs report now with Stuart Hoffman. He's chief economist at PNC Financial Services Group. He's also a Bloomberg best economic forecaster. And he says, though today's report is a bit confounding, that's using your words, Stu, it may be stronger than it appears, at least on the surface. And he joins us now from his office in, of all places, Pittsburgh. Good to see you, Stu, and good luck to you this weekend, this Sunday.
Yes, thank you. I'm a big Steelers fan, no doubt about it. But back to the employment report. Yeah, it was confounding because this is the third month in a row that the growth in payroll jobs came in below the consensus. Although I would note the last 2 months, November and December, they keep revising up. So this isn't the last word on this disappointment in January. But the other side of that is you get this big drop in the unemployment rate for the second month in a row. So which do you believe? The improvement in the market because the unemployment rate is going down, or the disappointment because jobs aren't going up? It's confounding. It doesn't make a lot of sense.
Stu, part of that's
distorted on both sides.
Stu, sorry for interrupting there, but part of that,
that's right,
you know, we're saying is explained by this very, very bad weather. Mike McKee was just on a little while ago talking about how we're probably going to see an acceleration now in payrolls going forward in the coming months.
Oh, I think we will. And that's why I think the markets are taking this number very much in stride. As you just had in your report, stocks are flat, up a little. And the bond market that, you know, normally would rally if job growth was disappointing is actually selling off a little more today. So I think the answer is the truth is in between. The unemployment rate has not dropped as much as the last couple of months, but job growth is either going to get revised up, or I agree, maybe, depending on what the weather does the rest of this month, as we get into the spring and that's less of a factor, I think we're going to see some really good months of job growth, March, April, and May, and average out these disappointing winter numbers.
You know, the bond market, we've been talking about stock investors not really reacting strongly one way or another to this report, but bond investors certainly are. You know, the 10-year yield right now is at a 3.64%. We haven't seen that in quite a while. Let's talk about inflation. I mean, this was something that was addressed yesterday by Fed Chairman Ben Bernanke. I was looking at sort of the implied probabilities for a potential raise in the Fed funds rate, and it's moving ever so slightly now, which is something we haven't seen for months.
Well, Chairman Bernanke said yesterday a self-sustaining expansion, which I think is a very apt term, but he said it hadn't quite taken hold yet. You need more job growth. So the report today doesn't exactly add that missing ingredient just yet. So the markets may be moving a little bit in terms of their expectations on the Fed will move. I think it's pretty clear the Fed is going to finish its quantitative easing, $600 billion, by mid-year, not add to that, not stop short. And I still think it's well over a year, maybe the spring of 2012, before the Fed starts to exit its near-zero funds rate. And if you look in the markets, that's about what they're saying, that it's at least a year away before the Fed overtly tries to raise its Fed funds rate target.
Let me ask you very quickly, Stu, the Bureau of Labor Statistics, obviously the way they report these numbers, it's sort of the devil is in the details here. But I know you're under the impression that they actually have underreported sort of the strength in the economy, or at least as it relates to the employment figures.
Well, let's just say it's out of sync. These weak employment numbers, not only the January rise at 36,000, but small increases or smaller increases, not smaller than that, but under 150 in November and December, fly in the face of the big drop in unemployment claims, the ADP number that's had two big back-to-back months, some of the JOLTS data, and some of the anecdotal data, and what we see in the ISM surveys. They all point to a pickup in job growth, yet the BLS's last couple of months show a slowdown in job growth, particularly private sector. One of them's out of sync, and I think it's this case, the payroll numbers are probably on the low side. Nothing wrong the BLS is doing. They're doing the numbers. I just think it'll be revised up down the road or offset more likely by bigger than expected gains in, say, March, April, and May, and will eventually average this out and show stronger job growth in the market since late last year through this year.
All right, Stu, thanks so much for joining us on this Friday.